Silver closed this week up more than 6%. Not intraday, not a spike that got sold the following morning like we saw back in January when silver briefly surged from around $103 to $120 before reversing almost immediately. This time, the move held. Silver closed the week near $80.41, up roughly $5 on the week. And that weekly close matters because it tells you something the January move did not. The market is making a statement. And if you understand what silver is actually reacting to right now, that statement becomes genuinely uncomfortable. Welcome to the 2% Brief. Let's start with what happened across markets this week, because the picture only makes sense when you see all the pieces together. Gold finished up around $104 on the week, roughly 2.3%. Closing near $4,721 an ounce. Still well beneath its all-time highs, but the trend remains intact and the buying pressure is not letting up. Silver, as we said, closed up 6.6%. But here's the detail that most people are not talking about. Platinum also rose this week, climbing $69 to just over $2,069 an ounce. That matters because it tells you this move is beginning to broaden. When only gold moves, you can attribute it to safe haven demand or central bank buying or any number of isolated factors. When silver and platinum start moving alongside it, the precious metals complex as a whole is reacting to something. And that something is worth paying attention to. Now here is where it gets interesting. Because at exactly the same time that precious metals are climbing, equities are sitting near record highs. The Dow closed this week near 49,600. The S&P 500, 7,399. The Nasdaq remains above 26,000. And here in the UK, the FTSE closed above 10,200. On the surface, that looks like confidence, like stability. But look at what else is happening simultaneously. Oil is back above $100 a barrel. Brent crude near 101, WTI around 95. The dollar index has slipped back below 98 to 97.9, and Bitcoin gained around 2.8% on the week to trade near $80,400. Now think about that dollar move for a moment. When oil is expensive and inflation risks remain persistent, conventional logic says the dollar should be holding firm or strengthening. Instead, it is weakening. And that tells you something important about what markets are pricing underneath the surface. Not just inflation fear, growth fear. The dollar is falling because investors are increasingly uncertain whether the US economy can sustain its current momentum. And precious metals are picking up on that signal earlier than equities are. Now, this week's economic data only deepened that picture. Factory orders came in stronger than expected, rising from 0.3% to 1.5%. That's a genuine positive. But almost everything else pointed towards slowing momentum. The S&P final US services PMI slipped from 51.3 to 51. ISM services edged lower from 54 to 53.6. Both still technically in expansion territory, but the trend is moving in the wrong direction. Then came the employment numbers. Now the ADP employment report actually strengthened slightly, rising from 190,000 to 200,000 jobs. But non-farm payrolls fell sharply, dropping from 185,000 to 115,000 jobs. Markets took some initial comfort from the fact that expectations had been set even lower, around 55,000. But that framing deserves scrutiny. When expectations for a major economic indicator have been revised down to 55,000 jobs, that itself tells you how concerned the market already was heading into the number. 115,000 beats a very low bar. It's not a sign of underlying strength. And here's the detail that should worry anyone watching inflation. Average hourly earnings rose from 3.4 to 3.6% year over year. Unemployment held unchanged at 4.3%. So what you have is a labour market that is simultaneously slowing in terms of job creation while wages continue to rise. That combination keeps inflation sticky even as growth softens. And that's precisely the environment that central banks find most difficult to navigate. Because if inflation stays elevated, rate cuts become very hard to justify. But if growth continues weakening, financial markets will start demanding easier policy regardless. The Fed is effectively caught between those two pressures right now, with very little room to move. This is exactly the kind of signal we track each week here on the 2% Brief. Not just whether markets are moving, but what they're actually telling us underneath the surface. And if that kind of analysis is useful to you, subscribing genuinely helps this channel continue doing that work. And this brings us back to silver. Historically, silver tends to lag gold in the early stages of a precious metals bull cycle. It underperforms. It frustrates people who hold it. And then, when monetary conditions begin shifting more aggressively, when inflation expectations start moving, when investor psychology begins changing underneath that surface, silver catches up. And it catches up fast. What we may be watching right now is exactly that rotation beginning. The gold to silver ratio falling back towards the high 50s is quietly one of the more significant technical signals of recent weeks. For a long period, silver significantly underperformed gold. That relationship now appears to be shifting. And when silver starts outperforming gold on a sustained basis, markets have historically interpreted that as a signal that something more fundamental is changing in the broader monetary environment. It's also worth noting that silver is not just a monetary metal. It has significant industrial demand, particularly in electronics, solar panels, and electric vehicles. A sustained silver rally, therefore, carries a dual signal. It suggests both monetary uncertainty and ongoing industrial demand, which means it is harder to dismiss as purely a fear trade. Now add into that the situation developing around Iran and the Strait of Hormuz. Roughly a fifth of global oil and gas supplies passes through that strait. This week saw US and Iranian naval forces exchanging fire, even as peace negotiations continued in parallel. Washington and Tehran are reportedly close to a memorandum of understanding that could end hostilities, but nothing is signed, and the situation remains genuinely fluid. If a deal is reached, oil could move sharply lower almost overnight. That would ease some inflationary pressure and potentially shift the macro picture considerably. But if talks collapse, oil stays elevated or goes higher. Shipping costs rise, transport costs rise, manufacturing costs rise, and central banks find themselves with even less room than they already have. Either outcome this coming week is significant, and markets have not fully priced either direction. Which brings us to the week ahead. On Tuesday, the latest US CPI inflation data arrives. March came in at 3.3% year over year. April's expected to print somewhere between 3.5 and 3.7, driven primarily by energy and food costs. Core inflation is expected to remain more contained, but even a modest upside surprise would further close the door on any near-term rate cuts. On Wednesday, producer price inflation. March PPI rose 0.5% month on month, with goods up 1.6% and services unchanged. Watch for any broadening of those pressures beyond energy, because that would suggest costs are beginning to feed through more widely into the economy. And on Thursday, US retail sales. This is the one that will test whether the consumer is genuinely holding up or whether higher energy costs are quietly beginning to bite into discretionary spending. Taking together, those three reports could significantly shift market expectations for the second half of 2026. Because if inflation stays sticky while consumer activity weakens, the stagflation narrative stops being a fringe concern and starts becoming the base case. And that's exactly the environment where precious metals stop being a niche conversation and starts attracting serious institutional attention. Silver just closed its best week of 2026. In a healthy, stable, expanding economy, that would simply be a positive return. But markets do not exist in isolation. And right now, silver is rising alongside elevated oil, a weakening dollar, slower job creation, sticky wages, while equity markets sit near record highs apparently unconcerned. One of those signals is wrong. Silver may simply be telling us which one. And if you want to understand why silver's move above $80 may matter far more than most investors currently realize, make sure you watch the video appearing on the screen now. It connects directly to everything we discussed today. And if you found this useful, I will be expanding further on the inflation and stagflation risks developing underneath in this Sunday's Inner Circle briefing on Substack. The link is in the description and comments section below. Thank you very much for watching, and I'll speak to you again very soon.